Hello, good morning or good afternoon, depending on where you're joining us from. Welcome to our webinar on strategic readiness for CRR3, adapting to financial regulatory evolution. Thanks so much for joining us. My name is Ronan Donnelly. I am a risk and regulatory reporting specialist here at Suade. And today we're joined by Martin Niesen, who is a partner at PWC in Frankfurt. Martin's responsible for leading the governance, risk and compliance division. And Martin also leads PWC's global Basel IV initiative. So Martin, thanks so much for taking the time.
It's a pleasure being here. Thank you for the invitation.
So today we're going to be talking about the CRR3, looking at the key aspects of the changes to the regulatory framework, the implications of those changes on European banks, and also the challenges and opportunities that will be presented by CRR3, with particular focus on capital requirements and risk management practices, among other factors. So Martin, we'll jump right into it, but before we look at the change, if you will, or the refresh of the framework from CRR2 to CRR3, thought it might be worthwhile just if you can give us a bit of an overview of the path that has been taken to get to where we are with the capital requirements regulation in its current form.
Yes, of course. Happy to do so. First of all, it's always very interesting or even funny to agree on how we call it. Actually, the industry calls it Basel IV. The regulators stick to the term the finalization of Basel III. In the US, it's called even more dramatic. They call it the Basel III Endgame. Yeah, so it's almost like a Marvel movie. In the UK, it's Basel 3.1. In the EU, it's CRR3. But it doesn't matter how you call it. The most important thing is actually that it's one of the biggest challenges for banks when it comes to the implementation of new regulatory requirements in the next 1.5 to 2 years, even after that. Actually, of course, when we look to the history of the Basel Accord and the Basel framework, Basel I was implemented in 1988, Basel II then in 2004, at least globally, and then implemented within the EU in 2008. And the last big reform was the introduction of the CRR, like the capital requirements regulation in 2014 that implemented also Basel III into European law. And then we had a smaller change, the CRR2, where also already some parts of Basel IV were implemented into European law. And now we are just before the big bang, where all the other new regulations will be implemented in European law. There was a draft that was published in October 2021. In summer this year, the political trilogue was finalized. So all the EU countries agreed on, yes, that's how we want to do it. But they forgot that they have to take care of some details. That's why the technical trilogue is still ongoing, and we expect maybe in the next weeks a final text and then a publication in the EU journal in the beginning of next year, and then the implementation still officially on the 1st of January 2025.
Perfect, thanks for that. And now focusing on those changes from CRR2 to CRR3, what is a high level? What's the CRR3 offering over and above what we currently have with the CRR2?
I mean, first of all, let me start with Basel IV altogether. And as I said, Basel IV was divided on EU level in two parts, but two packages, CRR2 and CRR3. And altogether, it's actually that all methods for the calculation of risk-weighted assets are going to change. Mm-hmm. And then when we focus now on CRR3, the main focus is on credit risk, and here on the two traditional approaches, the standardized approach, there's a complete overhaul. And also when we look to the IRB approach, the internal rating-based approach, there are also very significant changes. Apart from that, the CVA risk capital charge is going to change, originally introduced under Basel III and on EU level in 2014. It's going to change fundamentally, like all approaches are new. We have significant changes in FRTB, and a part of FRTB was already implemented in CRR2. Don't get confused by that, but until now it's only a reporting requirement. Now it will become a real capital requirement. And last but not least, there will be also a new approach for the calculation of capital requirements for operational risk. That's the quick overview of what the changes are. What is very important when we look to both the changes that were in the CR2 package and the CR3 package, they are all interconnected. You can't look at it isolated. So some changes in CR3 will have impact on CR2 and vice versa. That even makes it more complicated.
Makes sense. So if we start with credit risk, the credit risk framework part of the package. So as you said, there's some significant changes being made there to both the standardized approach as well as the restrictions on the use of the internal ratings-based approach to calculate capital requirements. What are some of the challenges that you think banks or financial institutions might face under CRR3 based on their size, location, complexity of operation, etc., as a result of those changes?
Yeah, I think one thing is very important to consider when we speak about CRR3, and that is because the changes are only focusing on RWA, and one of the goals of the Basel Committee was to make the overall framework more risk sensitive. That means also that the changes and the impact are very individual. In the past, normally when we were speaking about regulatory changes, banks were affected more or less the same way. So there were not so many differences. Normally it was a big bank, small bank, depending on the country. This is going to be very different now under CRR3 because credit business especially is different from country to country. Also within the EU, we always speak about a banking union, but so unified it's not. And also each bank has their own risk appetite. And depending on the risk appetite, when the framework is more risk sensitive, the impact will be also more sensitive. We will see later a slide on that I brought to you. But maybe, first of all, having a quick look to some examples of what is going to change. When we look to the standardized approach, one important change is that in the future there will be the requirement for a due diligence. So you cannot only focus only on the external rating and derive the risk weight on it. You always have to make your own assessment. You could say now, oh, that's normal, but it seems that some banks were not doing it. So that's why they were writing it in the CRR now very explicitly. Also that the risk weights for banks will be not depending only on the external rating anymore, especially for banks that have no external rating. The risk weights will be completely different. And that is going to be a quite significant impact because currently the risk weight for unrated banks is based on the rating of the sovereign the bank is located in. And most EU countries have a very good rating. So the risk weights for the banks there, when they're unrated, is 20%, and it will go up now to 40%. Sounds not so much, but actually it's double. 20%, 40%. It's a double jump. So in cost of capital terms, that's a quite significant increase. Second point that I would like to mention here, of course, is everything around real estate exposures. Maybe you can jump one slide back because there we saw the, yes, there you can see it. The risk weighting of the real estate exposures will be also much more risk sensitive. There will be not only the pure differentiation between commercial real estate and residential real estate. One completely new term is introduced, and that is income producing real estate. There, of course, the risks are higher and also the risk weights therefore are higher. So banks that are focusing on this type of real estate business, they will face significant increases. The biggest challenge actually in reality is when we started now the projects with our clients on the implementation or performing impact analysis is what is actually income producing, because it's a pure regulatory definition. It was not in the systems before. So first of all, you need the differentiation in the system, and then you know what the impact might be. And there's another, a new category of real estate exposures, and that is called ADC, acquisition, development, and construction. Also, these kind of exposures will have much higher risk weights. And also to identify these exposures is already a significant challenge. And both, or when we look to all the changes, there's one impact on the capital, like where the risk weights are increasing or decreasing, but we also have to consider what is the fault of implementation. And we also try to indicate that on these slides. But of course, these are average values for each individual bank. It can be, again, a little bit different. Another point in the standardized approach that I would like to discuss with you is subordinated debt and equity position. Sounds quite innocent, but again, can be a quite significant challenge, because right now there is no differentiation in the standardized approach. It's always when it's unrated 100%. In the future, subordinated debt will receive a risk weight of 150%, so 50% higher cost of capital. And for equity exposures, in some cases, it can go up to 400%. So it's 4 times higher. And again, the big challenge is to identify these kind of exposures, because again, it's a pure regulatory definition of what is equity position and pure regulatory what is subordinated. You simply can't use the normal data fields that you maybe have in your systems. And a lot of banks that we work with were very surprised in the end how much of these kind of exposures, according to the regulatory definition, they have on their books, and therefore their impact was influenced. That were, I would say, the most important topics. There are many other changes, of course, in the standardized approach that might impact the banks. There's one change that impacts both the standardized approach and the IRB approach. So maybe it's a good transition to go to the IRB approach as well. And that is the credit conversion factor. In some cases, now you can apply a credit conversion factor of 0% for undrawn credit lines that are cancelable at any time. In the future, the floor will be 10%. So all unused credit limits will produce cost of capital. So that might be a huge challenge for the banks, especially when they were very generous in the past with these kind of undrawn facilities, because they costed no money, no cost of capital in the past, and also no refinancing costs. So when a client came, they got more than they maybe needed. Now it produces costs of capital, and banks have to face this challenge. So that's it regarding the standardized approach. Of course, as I said, many more changes, but we have to try to keep it short here.
Sure. Yeah, I mean, obviously the idea is to reduce variability in RWAs across institutions, but as you say, by making it more risk sensitive, it may in fact kind of make it more complex. So it'll be interesting to see how that actually plays out. Moving on just to CVAs and the changes there. So there's going to be some new approaches that are introduced. Also, again, removal of the use of the internal modeled approaches. And importantly, banks can also now use a combination of the different approaches for different counterparties and etc. What's the rationale, first of all, behind removing the internal modeled approaches there, in your opinion? And what are the key kind of challenges in transitioning to these new CVA calculation approaches?
Yeah, I try to keep it here also as short as possible. I would say simply the Basel Committee realized that the approaches that are currently in use are not adequate. So it was introduced with Basel III for the first time, so it was new for them as well. And when they performed their backtesting, they realized that it's simply not working. So they came up with 2 new approaches on the CVA risk capital charge. Actually, there are 4 approaches, to be honest, because there's one standardized approach, which is almost an internal approach. And then there's the basic approach. The basic approach is divided again in 2 sub-approaches, the comprehensive and the basic approach. And there's still a simplified approach that can be used only for smaller banks. Based on what we have observed, most of the banks will go to the basic approach. The standardized approach is very complicated. It's very similar to the standardized approach for FRTB, but only with CVA sensitivities, and that is very hard to model. And you even need an approval from your regulator if you want to apply or if you want to use that that approach. So it's really difficult. So only the large internationally active banks will go for the standardized approach for CVA. Yeah.
Thanks for that. Okay, moving on to the market risk now and the implementation of FRTB in the EU. Sorry, Martin.
Yeah, or what we can also do is I brought also one slide on IRB approach, the other big approach for credit risk that we could cover as well. Maybe if you
Sure.
could jump quickly to the slide where we write overview of changes in IRB. Ah, there it is already. Yeah. So maybe very quickly, because also about the IRB approach, we could speak a lot. Biggest change, of course, is the scope of IRB. For certain exposure classes, you can't use the IRB approach at all anymore. And for some other exposure classes, you can't use the advanced IRB approach anymore, where you estimate all risk parameters. That can have a quite significant impact on the RWA, of course, because LGDs in the advanced approach are normally lower than in the foundation IRB approach. What is also very important is when we speak about the advanced IRB approach, there are some parameter floors for the PD, but actually in reality, they don't play such a big role. Which floors play a very big role is the floors on the LGD side. Based on our observations, pretty much underestimated by the banks, because the impact is much higher than expected. Also because we have to somehow calculate some kind of weighted average LGD floors. A lot of banks were overseeing that, also because the Basel text is not very clear here, but the EU text is very clear on that. And last but not least, when we speak about the foundation IRB approach, there banks actually have the possibility to reduce risk-weighted assets because you can consider much better collaterals, and even more better is that you can consider now over collateralization. Last word maybe on the IRB approach, a big change is also the change in the philosophy of the partial use, like where you use IRB in parallel to standardized approach. That's now much more flexible. And that's also the reason why we see currently a boom in IRB projects for medium-sized banks. They were before prevented from using the IRB approach because they were not able to roll it out to the total portfolio, but now it's much more flexible. So a lot of banks now move to IRB approach, which is surprising. In 5 years ago, I would never have expected that, but now it's a important development.
Yeah. Before we move on from that, just one point from me. So I know the advanced IRB approach has been removed for large corporates and FIs, so they're obviously going to have higher costs of capital now. Do you think that that's going to be pushed on to customers by any chance, or absorbed in the financial system, or because I think that's going to be a particular big challenge as well?
Yeah, the issue is that that is a very competitive market environment. Banks are fighting for these large corporates. So I also wonder if they can pass through the higher cost of capital. Yeah. But considering that the overall level of interest rates changed in the recent months, and the margins are much better and bigger, the cost of capital is only a minor part of the overall margin. So I would say the customers will feel the overall change in the interest rate much more than the change in the cost of capital. Yeah, relatively, it's a minor part. Sure. But there will be an increase.
Okay, thanks. Market risk, FRTB. So I guess just what are the challenges that for EU banks in getting that implemented in terms of risk calculation and reporting? Some thoughts?
Yeah, looking from CRR2, because a part had to be implemented in CRR2 already, especially the standardized approach as a reporting requirement for those banks where it's relevant. Now it's going to become a real capital requirement, both for the standardized approach and for the internal model-based approach. Internal models are also completely overhauled, moving away from valued risk to an expected shortfall calculation, much more difficult to model. But what is relevant for all banks, no matter if they have a big trading book or not, is the change in the definition of what trading actually is. So the trading book boundary. And that can lead to the situation that banks that had a small trading book will have now a bigger trading book, or banks that had a bigger trading book have a smaller trading book. And that has an of course, a huge influence how the banks are doing business, because the big change in the definition of the trading book boundary is simply that some exposures, some trades, some deals must be assigned always to the trading book or always to the banking book. And then, of course, the impact can be quite different. And looking to the standardized approach, of course, we can say that that is a huge challenge for the implementation. So if you have a trading book exposure, significant trading book exposure, most of the banks will go for the standardized approach. And the internal model-based approach will be only relevant, to be honest, for the really large investment banks that have a huge trading portfolio. Even the larger banks here in Europe that use currently internal models will move back from these internal models into the standardized approach, because these expected shortfall calculations are too complex and very difficult to get the approval from the regulator. No.
Yeah, it'll be interesting to see how the redefined trading book, banking book, you know, and the regulations and requirements governing those activities,
Yep.
how that all plays out as well. We've got about 9 minutes left, so good to get on to the juiciest topic out of the discussion, the output floor.
Yeah.
So this was obviously a point of contention, not only among the Basel committee members, but also, you know, the financial industry more broadly. We've reached a 72.5% final a number or amount for the requirement of the standardized approach. So essentially what this means is that banks are now going to also have to calculate the standardized approach as well as using their internal models. So how will this implementation of the output floor affect you know, banks planning and risk management strategies?
Yeah, you mentioned it already. The implementation of the standardized approach for banks that are used only to use internal models is actually a big challenge. And a lot of banks underestimated that simply. Banks thought like, oh, when I can do internal, then I can do standardized as well. But the data that has to be used is very different from what is used in the internal models. So banks don't have that available in their regulatory reporting systems or in their data warehouses. So it's a big challenge to implement it. And so far, most of the banks, they never had to deal with the standardized approach at all. So they start from scratch. So it's a big challenge from an IT perspective. And what is very important, the output floor in most of the cases will determine the future RWA, because the output floor is relevant for most of the banks that are using internal models right now. And therefore, the quality of the implementation of the standardized approaches for being able to calculate the output floor must be very good. It must be the same quality actually as the internal models. Yeah, because it will determine the capital ratio. Yeah, and also what we have to consider is that the reporting requirements, the core rep reporting, yeah, will be the same intense as if the banks are using only the standardized approach. You can bet on that. Yeah, so banks will not only have to send the reports on the IRB approach, which is their main approach, they will also have to send the whole amount of templates for the standardized approach. So it will double actually the amount of regulatory reporting they have to do on RWA. So it's also a lot of work and a lot of quality assurance that you have to do. And not to forget, of course, the RWA impact that the output floor causes. If you look to some of the large internationally active banks, they have an average RWA density in the internal models of around about 30–40%. Yeah, standardized approach is at 80%. So if these banks have to jump now from these 40% or 30% to 60%, 70%, considering the output floor, that is almost double RWA. So imagine as a bank that faces suddenly a double RWA, that's a huge impact and will change the business model of the banks. Yeah, and that is not the last challenge. What we say now after implementing the first calculation engines within the banks, you will have to start to think about how to reallocate the impact of the output floor, because the output floor is calculated on top level, like you add up RWA of credit risk, market risk, and operational risk, and then you multiply it by 72.5%. But then the big question is, who's guilty of that? Which business entity has to pay for this? And because it's a calculation that is performed on top of the RWA, there are a lot of synergies between the areas. We have here on this slide a nice example on that. So if you can say you have an increase because of the output flow of 20% of RWA, you will have to break down these 20% to credit risk, market risk, operational risk. And for credit risk, we will have to think about, okay, what is commercial business, what is retail business, or what is mortgages, and so on and so forth. So that is a very, very big challenge, because only then you can include it also in your pricing, in your cost of capital calculation. So a huge challenge, again, with a very, very big strategic implication, because banks, of course, try to optimize the output floor impact. Maybe before we reach the end, we can jump quickly to one slide that I brought to you also that summarizes the impact of the CRR3 that we have observed with our clients. And that is slide number 6 with the title CRR3 RWA impact. And what I would like to say is here, do not get irritated or influenced by these average numbers that you read in the press or publications by the Basel Committee itself. More important is the huge variation of results that we have observed in our impact calculations that we have performed with our clients. And there were large banks, international active banks, smaller banks, specialized banks, regional active banks. And what you see on this slide, and I only raise your attention to the first point, the total RWA. You can say, of course, what is the average impact? We calculated that. Also, you see, when you consider the first stage of the floor, the 50%, it's 10% in average, and 20% if you use the fully phased-in floor. But that's not important. It's the variation. So for the first time, for example, we see banks that can reduce actually their RWA under Basel IV. Something that was never happening before. Normally, new regulatory requirements are always bad, but these banks are actually winners of the reform. But on the other hand, we see also banks that have an increase of up to 30–40%, and everything in between is possible as well. And banks have to perform these impact analysis, detailed impact analysis on their own for being able to understand from where the impact comes, and then also making more detailed analysis, because it's not so important if you know, for example, that your overall impact is an increase of 10%. You will have to know is what is the impact on credit risk, and when we speak about credit risk, what is the impact on retail exposures, what is it on commercial exposures, and so on and so forth. Because depending on that, you will react. Because it might be possible that for retail you have a decrease of RWA, but for commercial business you have an increase. So as a board of director, you will have to react to that. You can't say simply, okay, 10% in average is also fine. It's more the details that are important, and therefore Basel IV CRR3 has a much more strategic impact than all other regulatory reforms that we have seen in the past.
Thanks for that. We've got 1 minute left, so just thought I would open it up to anybody on the line. If you wanted to ask any questions, please feel free. If not, I think we might leave it there. Martin, thank you so much for joining us today. That was hugely insightful, and really appreciate your time. And thank you all for dialing in. Have a good day.
Thank you very much. If you have any further questions, do not hesitate to contact me or the colleagues from Suade. Thanks. Bye.
Thank you very much. Thanks again, Martin. Bye-bye.
Bye.